You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, that music means it is time once again for the old OBC, a.k.a. the Options Bootcamp, a.k.a. the program for you, the busy retail stock trader. Maybe you're thinking about dipping your toes in those options waters. Maybe you're one of the hordes, the legion of one-lot traders coming at us from the Robin Hoods and the Weebles, or maybe the more traditional brokers out there. You've discovered options in 2020. You want to learn more. Either way, we got you covered here on Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. I remind you of two things. First off, if you just tune in to Options Bootcamp, you're missing a whole heck of a lot of other content hitting you pretty much twice a day throughout the rest of the week here on the network. So if you have more questions about how these options things work, how they impact your portfolio, things like volatility or futures options or anything else, we got it covered there. So wherever you listen to this, make sure, A, you subscribe to our full network, not just to the Options Bootcamp, even though we like you folks too. And then B, you leave those reviews if you like what you hear so folks can continue to discover the network in these troubled times. And C, I'm going to add in a third one. You keep those questions coming because it's especially important like a day like today when we're going to do a mail call Palooza. And once again, joining me to help me answer your options-oriented queries, we got the black-headed one himself, Mr. Dan Passarelli from Market Taker Mentoring 2Ts. Mr. P, welcome back to the program, sir.
Super glad to be back. I love the mail call Palooza.
All right, then. Let's do it. Without further, it is time for your questions. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call. We'll see how many of you guys we could squeeze in on today's episode. Your questions are many and varied, and we like it that way. Let's kick it off with Jake. Jake Hatter. Of course, we just did a whole conversation about second-order Greeks, listeners. Jake wants to know, how the heck did Gamma become part of the Greeks when it's really a second-order Greek? Yeah, we kind of touched on that last episode there, Jake. But, the gist of our conversation was most people, you're right, don't realize when they're looking at the Greeks, the big 4 plus rho, delta, gamma, theta, vega, they think, of your traditional first order type derivatives, and that's what they're thinking of. And then they get to something like gamma, And usually they have a moment of hesitation. They have to scratch their chin. Like, wait a minute, this thing is not measuring something on its own. It's actually measuring the rate of change of another one of these variables here that I'm supposed to be familiar with. And that usually tends to throw a bit of a wrench in their options education. They kind of stumble a little bit over gamma. So you're right, it is kind of a stealthy second order Greek. As for how it got bumped into and included in the Big Five, Dan, do you tell that story in your trading options Greeks? Do you tell the story of how gamma snuck its way into the Big Four plus Roser?
Well, no, I mean, I don't tell the story per se, but, like you think about it, like the biggest effect on your P&L is typically delta. And so because delta changes and sometimes, when you get close to expiration, delta can change drastically as the stock goes up or down. I feel like it's definitely the most important of those second order Greeks.
Definitely is. Doesn't get the inclusion in that conversation all too often, which is why we wanted to talk about it on our episode last month. Just to give you some reminder that it is a second order Greek, which is probably why you're having a little bit of trouble understanding it. And it doesn't get included in that conversation all too often. I'm not sure why. So we wanted to make sure we rectify that. And good for you, Jake, for pointing it out. Yeah, gamma, a stealthy kind of ninja Greek. It snuck its way in there when perhaps it should have been reserved for the second order. But again, it is important. You need to know it. So that's probably how it made its way into the Big Four. The next up, we got a comment, Dan, from Christopher Lovell. Maybe he was listening to our live election special, which hopefully you listened to, listeners. I know a lot of you did. If you missed some or any part of it, really, most of it has hit the network already. I think there's a few chunks left. We tried to break it down for you guys into smaller, bite-sized, roughly half-hour chunks, so you guys can get all of it without having to sit there and commit to whatever. It was 4 hours of intense talking on my part. So hopefully you guys are enjoying that. But I think Christopher was listening, Dan, because he says, Mark Longo and Dan Passarelli for office with a bunch of exclamation points. Okay, I'm down with that. How about this, Dan? We'll do a ticket, and I'll be president, and you could be, what do you think, Secretary of State? Does that work for you? Are you up on the whole Syria situation? What's going on there?
No, I'm a power monger. If I can't be president, I want to be above you. I want to be emperor, maybe. How about that? Emperor
Passarelli. Tell you what, I'll be president. You could be under Secretary of Labor. How about that? It's getting more exciting by the minute. We appreciate your kind words there, Christopher Love. How about Longo Passarelli combo ticket? Is that too much Italian for America to handle, sir?
No, we need more Italian.
I agree. More Italian in the White House could go. More vowels in the White House. What do you think? Can go a long way here. I think Christopher would be down for that. All right. Next up, we've got Mexicant. Maybe he's a Mexicant. In which case, why are you a Mexicant? You want to be. It's kind of like being glass half empty. You want to be a Mexican. You want to be optimistic as opposed to a Mexicant. Either way, Mexican wants to know, what's the better earnings trade? Buying calls a week before the earnings or buying the calls the day before the announcement? For both, I assume exit on the open of the next session after the announcement. Oh, that's interesting. We've talked about all sorts of variations of this question over the years. It does seem like earnings trading is a bit of a fixation and fascination for a lot of our audience, which is why listeners over there at theoptionsinsider.com, we provide you with completely free of charge, the earnings move results, and earnings season reports. You could see exactly what these names are pricing in heading into their earnings in terms of an earnings volatility premium, how they've performed in the past, how maybe their most recent move results break down. So you could see how they performed in their most recent announcement compared to what was expected. And, of course, the season breakdown as well. So how that season is shaping up, all courtesy of our friends over there in ORATS land. So if you like this kind of data, and it sounds like Mexicant does, then he should, or perhaps she, should be checking that out. But I have some thoughts on this, Dan. But I know you have your whole systematic approach over there to how you guys approach earnings at MTM. So what do you have to say here for Mexicant?
Yeah, so we do. We have one of our best systems actually is the total earnings domination system that we talk about. And our studies show that buying calls before earnings, whether it's a week before or even the day before, is usually going to be a losing proposition. The implied volatility ramps up long before a week before. It's tough. We've been studying it and trying to come up with even better ways. And there are some things in this regard that we are studying. But our total earnings domination system, which involves very specific time spreads that meet very specific criteria or occasionally straddles, work way, way better than what you're talking about. And for those of you who are watching shortly before earnings season, if you're on our email list, which if you just, join our website with the free membership, you're on our email list. And next time we do a presentation on that, be sure to join it. There's some really, really great stuff in that system.
Yeah, this is a tough way to go, particularly if you're, for the traditional audience of this show, you're new to options. Trading options around earnings usually requires a pretty deft hand and a pretty strong knowledge of options. It's all about when to get in and when to get out, as your kind of question alludes. So I'd be much more comfortable if you said Mexicant, if you were talking about maybe buying the week before and then maybe exiting before the event. When you're holding it through, just kind of naked holding it through the event, I've kind of used the illusion in the past. You're kind of like you're riding that barrel over the falls, right? It's out of your hands at that point. You're kind of just left up to the whim of the gods as to how well that works out. And if you're long premium, as Dan points out, that's a challenging thing to do, which is why he does things like time spreads and other things to try to offset that a little bit. And I encourage you, if you're interested in more, check out his system for the specifics. But just buying the old call the day of or even the week before and then riding it all the way through the earnings announcement. The problem is, unless there's a huge surprise on those moments, that balloon, I've said it before, that balloon fills up with your earnings vol fills up, and then the event happens, and unless there's a huge surprise, that balloon pops. And so you're left kind of holding the remnants of that balloon in your long premium position, and you're going to see a huge implosion in your vol and the price of your option if you're not careful. So, of course, you might say, well, then I should sell the option. That's not always the case as well, because the few times that it doesn't work out that way is a huge move, and that can come back to bite you even more than the other way, and that could cost you more of your profits as well, which is why we've said through a lot of analysis, it's kind of a bit of a crapshoot on how you're doing this unless you have a very systematic approach to doing it here. So, yeah, I'm not really super comfortable recommending either of the approaches you have here, Mexicant. But we have talked about earnings trading on this show in the past a little bit as well. Again, also check out our shows like the Advisor's Option and other ones like that, where guys like Matt do a lot of back testing on these types of trading, so you can see how some strategies have performed in the past, or hit up Dan for some ways you can do it outside of just the kind of basic plain vanilla, I want to buy a call before earnings, because you and your mother and everybody else's mother have had that same idea, and doesn't always work out the best for you. Patrick wants to know, similar kind of question here. He wants to know, if I wanted to buy an option during earnings season, should I buy it early or right before? It's kind of the same question. I guess we should have read these two together. So yeah, same question here, Patrick. See what we just said here for Mexicant. Hit up Dan over there at MTM if you want his specific system. There's a lot of different approaches to it. Like we said, some people like to put it on a week or two before, and the reason they like to do that is because you're heading into the event still. The decay you're going to suffer is kind of limited because the vol is still creeping up to offset that decay. And then it happens, usually it all comes exploding out after the event itself. So if you have it on a little bit before and then maybe take it off before, you get maybe a few sessions of reduced or perhaps even free decay, a little bit of a cheap or free swing at the bat there. Right before, then you're kind of just rolling the dice on the board. Are you coming in saying, hey, I want black on the roulette wheel, and there's probably better odds on that than maybe buying it on earnings here. But yeah, see what we just talked about before there, Patrick. All right, Bartlett. Bartlett says, hey, boot camp. Well, hey, Patrick. Or excuse me, hey, Bartlett. He says, love the show. It's helped me to save so much money. Well, I'm glad to hear that, Bartlett. Good for you. He goes on to say, I have a question about a recent profitable trade of mine. I bought 6 approximately 5% monthly out-of-the-money calls, so 5% out-of-the-money monthly calls, I think is what he's trying to say there, in Tesla, everyone's favorite Tesla. He says the total outlay was around $5,200. We had a big pop, and I took off half the position for about $5,500. Well, there you go. So yes, he says, so I covered my trade. Well done there, Bartlett. He goes on to say, but the stock has since kept rallying, and now each of those calls is worth almost the value of my initial trade. Did I make the right call cutting off half of the trade? Because my head says yes, but my account currently says no. Great question, Bartlett. You kind of illuminate, I think, a problem a lot of people have with options, just trading in general. By the way, I don't remember when this question came in, so I don't know exactly where he had these calls on during Tesla here. But Tesla's had a few runs of late, so it could have been pretty much any of them. But Dan, this is kind of a frequent refrain. I've said it before. I think for a certain segment of the audience, they would almost prefer to lose money outright than to miss out on big wins in the thing, and which to me has always been a bit of a head-scratching outlook for trading. I would prefer to be like Bartlett. I mean, I don't know why he puts this profitable in quotes. It sounds like he definitely made money on this trade, and I think he did the right thing. That's something we teach all the time here, is when you have something happens, when the trade moves in your favor, you have to do something. If you have a question, Bartlett, about how this could go against you, just listen to any of our option block shows we've done over the past couple of weeks. We've been reviewing some of the unusual trades we've highlighted there, and there's been a ton of them that worked out really well in their favor and then retreated right back the other direction. And the person, in this case, they didn't have 6. They'd have 5, 10, 15,000 contracts on, and they didn't do anything, and they lost millions of dollars as a result. So when things move your way, particularly when you're long premium, you need to do something. If you just sit there waiting, your options are going to decay to a point where you lose a lot of your value, or something else is going to happen. The underlying is going to turn against you. So I think you definitely did the right thing. Pair off some of it. You didn't close the whole thing out. You gave yourself room to keep participating, and it sounds like you did. It sounds like this trade worked out great. I don't know why he's questioning this, Dan.
I'm trying to read this. Maybe what he means is that on the second half where he says, but the stock has since kept rallying, which, obviously sounds great. And now each of those calls is worth almost the value of the initial trade. So maybe he lost, he made on Delta, but lost on Theta and Vega is kind of what I might be inferring here on the second, on the half that he left on.
Maybe. I mean, my assumption was it rallied so hard that each of those calls is now worth around $5,000, right? He paid $5,000 for all 6 of them to start, and now each one of them is worth $5,000. So he thinks he left money on the table.
Oh, yeah. Well, I'll tell you what, my answer to this question is the same either way, which, and listen closely. I think this is important to be a good risk manager. My answer is the same either way. If scenario A, you took off half the position and you locked in $300, which is, not so bad, 6% in a very short period of time. Great. And if the second half you ended up scratching, then you made money, and it was very smart to take off that half the first time. If Mark's interpretation of this, where you tripled your money because the 3 calls that you're left with are worth what you paid for the initial, trade each, then you still made a really smart thing, because you could have gone wrong. Tesla could have fallen, a whole bunch, and you could have been out. Management makes money. That's my 3 M's of investing. I say this all the time. It's the key to success. Your primary job as a risk manager, taking off risk. And yeah, it sounds like either way you traded this great.
Yeah, I think you should be very proud of yourself there, Mr. or Mrs. Bartlett. I don't see why you put profitable in quotes. I think you did all right here. You did the right thing on this. If you do nothing, you see what happens. We just talked about Delta's bleeding on our last show, but your options value is going to bleed. So you need to have that pop. You need to have it happen pretty soon in your options lifespan. It sounds like it did, and you did exactly the right thing. You took advantage of it, so your risk beyond that was minimal. You made money more beyond that, I think. Maybe Dan's more cynical than me. Maybe he's a Mexicant. He says you lost money, but either way, it's interesting stuff. All right, next up, speaking of interesting stuff, let's see what else we've got here. Nancy T says, this is kind of something we just touched on, Dan, earlier, I think on around our election special, maybe right after that. Nancy T wants to know, why is there no options trading after 4:30 p.m.? Obviously looking from an East Coast perspective there. But, you have to caveat that there, Nancy, because there is options trading after that time. Just depends where you're looking. Obviously, we do a lot on the futures options front over there, and there's clearly options trading close to 24/7 on a lot of those products out there. So again, if you're looking at maybe the big indices or crude oil or corn, like Dan was talking about earlier, out there, you can trade those pretty much around the clock, but your traditional Apple and your SPY, not so much. And I'm guessing that's probably what you're alluding to. Dan, we kind of touched on this very recently. So do you have anything else to add on the notion of why there is no options trading after 4:30 and then B, would you be a fan of it if there was?
Well, that's when all the traders are in the bars.
That's true. They're all too drunk to trade.
Yeah, no, I mean, I don't know. I think it's nice to have a breather. I mean, if just not for mental health, but, it gives people time to think about stuff. And, I mean, even the underlying stock market is not even quite that liquid. When stocks trade in after hours or pre-market, the options market would be pretty illiquid. It would probably be a little dangerous, I think.
That's when it gets fun, Dan. Live a little. Get out of the bar and live a little in those illiquid options hours. But yeah, we just talked about this, Nancy, not too long ago, so I'm not going to spend a ton of time on this. It seems like maybe an election brought people back to thinking about trading after hours again. But see our conversation earlier about this. Doesn't seem like it's happening again anytime soon here, Nancy. So you have to live with the current setup, at least for now. All right, next up, MLB3 says, am I correct in assuming that when I'm long gamma, I'm always going to be paying theta? Is there any way around that, or is that just the price of doing business? Well, traditionally, gamma and theta, we just talked a whole bunch on the last episode about second-order Greeks, but gamma is in there as well. Gamma is a second-order Greek. Theta is not, but gamma and theta, kind of two sides of the same coin, as you point out here correctly. MLB3. If you have a lot of gamma, easy for me to say. If you have a lot of gamma, you traditionally do have to pay a lot of theta. Now, there are things you could do. Usually it involves spreads. You have to have some sort of short leg to offset the long gamma. That will reduce the overall amount of theta you have to pay. The trade-off, of course, is it's probably going to reduce your gamma as well. So the net position you may end up with, if you really are striving hard to eliminate all of that theta, is a position that doesn't have a heck of a lot of gamma, which is maybe why you put that position on in the first place. So sometimes I often caution people when they want to go down this road, because this is the question we've received variations on in the past, is that, the answer to this may not be exactly what you want, or indeed what you're looking for. Sometimes you're paying a little bit for that gamma because you want it. You want to have gamma. You want to have that bang for your buck. If you kind of spread it all away, or in the worst case, some of these positions, you put on things that are naked short units in one direction or the other, and you have a lot of risk on top of that, which is not exactly desirable. Dan, what are your thoughts on gamma versus theta? Are you always paying theta? And what are your thoughts around ways of getting around that, sir?
Yeah, there is a fairly direct relationship that the bigger your gamma gets, the bigger your theta gets. One's positive, one's negative. So one always helps you and one always hurts you, and there's really no escaping that. But that said, we see somewhat of a relationship with Vega, where when you're positive gamma, you're positive Vega, negative theta, you're positive Vega. But that one kind of goes out a little bit out the window when we're talking about spreads, particularly time spreads. But yeah, I mean, you're spot on there. MLB3, bigger the gamma, bigger the theta. You gotta deal with one if you're benefiting from the other.
Yeah, I'd recommend you peruse some of our episodes we did on time spreads. Those are kind of an options 201, a little bit more advanced. You can sometimes play with those relationships a little bit there as well. But at the end of the day, gamma and theta kind of go hand in hand. You can't really have a lot of one with just a little bit of the other. Some of the lengths I've seen people go to try to minimize that, it ends up with a position that is kind of just terrifying at the end. They're naked short units all over the place, or something else crazy that just is not probably what you envisioned going into that. So be careful going down that road, MLB3. And I encourage you to investigate some time spreads if you want to get into playing some of that game. But yeah, at the end of the day, for most folks out there in most positions, gamma, theta, evil stepsister, stepbrother of each other. I don't know which one's the evil one in there. I guess it depends on which side of the coin you're trading. All right, next up, I like this handle, Awesome, with the 3. Awesome. I guess he's just awesome. Awesome wants to know, what is the best broker for new options traders? Interesting question. I may cheat and start the opposite way. I may say the broker that I probably should not go to as a new options trader. That's going to be IB, Interactive Broker. And they pretty much say this when they come out there. They don't want the newcomer guy doing 1 lots and 3 lots and 5 lots. They want the professional guy who's going to take advantage of their margin and everything else and has a minimum of hand-holding because they view it, and could be viewed rightly, I suppose. There's a lot of cost associated with it. They just don't want to deal with. So IB probably where I would not recommend for a newcomer. Now, there used to be some other ones that were pretty easy. Toss, Thinkorswim used to be a pretty reliable platform. It could be a little bit overwhelming. It offers a lot. So maybe from a newcomer, that could be a little bit intimidating. Of course, Thinkorswim, part of TD, which is now part of Schwab. And Schwab hasn't had the best track record of maintaining and developing their platforms out there. So I'm less enthusiastic about that recommendation. And then some people might say, well, the flip side, go to these new brokers that are super, everyone's all jazzed about, your Robinhoods and stuff. And they're certainly doing a lot of paper out there because they say, because they're cheap, right? That's what they want. But I think for a newcomer, you want the hand-holding as well. You want someone with some service so you could call up if you have questions, like clearly a lot of you do. You can contact someone there. Maybe they have education. That would be nice to explain to you what the heck you're doing. We know Robinhood doesn't really offer a lot of that yet, so that's why I'm hesitant to recommend that on a newcomer as well. So Dan, I'm kind of in a bit of a flux with this one. I know what not to recommend, but my usual go-tos I'm not as enthusiastic about anymore. Do you have thoughts people are coming to you guys all the time. What is your recommendation for the newbie options trader, sir?
Yeah, there's a number of great ones out there. And I will tell you, there's not one that does everything exactly how I want it. A lot of them are customizable, but there's Tradier, there's Thinkorswim, AGT, Fidelity, if you're using options for investing, is super great. There's a number of them, and it's not bad to try some out and paper trade them on their system, see if you like it, and make the decision, because once you start using one, it can be hard to switch. So you kind of want to do a little bit of research going in, but the ones I just mentioned are some great starting points.
That's a good point about Fidelity. We did a long run with them on the option block program. They have and are working on developing their options bench in terms of people there who have expertise in the option space. And their platform has gotten a lot better in terms of functionality. So again, Fidelity, not maybe the first name you think of when it comes to options, but probably you may have some accounts there already. And if that's the case, then flipping that switch on to turn on the options is pretty easy. And of course, the cost thing is nice because most of the major brokers have adopted pretty much the same cost structure now. So you don't really have to worry about going to a quote-unquote low-cost broker anymore to save money because they all pretty much charge about the same, usually no ticket charge, somewhere around 60-odd cents a contract. So you don't have to worry about that as much. So if you have a traditional account, some of these more established platforms, try them out, see what you think. And we'd love to hear your recommendations out there as well for what platforms you're using now. Are you still using some of those traditional ones you just recommended? Maybe you have some other ones you liked. I've heard interesting things about Robinhood. I haven't used it myself yet. I want to kind of kick the tires for myself over there to hear what everyone's talking about, but I've heard things on both sides of the spectrum about that. But a lot of fun stuff out there. All right, let's be nice, Dan. We'll do one more. We'll wrap it up here with one more. Let's go to, this is an interesting handle, S9DBDE. I have no idea what that's supposed to signify there. Why would I ever buy stocks when I can just put on bullish risk reversals in any stock that I want and get pretty much the same exposure? Well, hey, you're not going to hear much argument from us. I'm a big fan of a good bullish risk reversal. I'm sure Dan probably is as well. A couple of caveats, though. You're probably not going to get the same exposure. If you're talking just about Delta, it's going to be some fraction of 100. It's probably going to be maybe a 50 if you use a traditional risk reversal, maybe a 75 or 80 if you do a little bit meatier options there. So it's not going to be 1-to-1. Stock obviously has a delta of 1 or 100. You're not going to get that unless you do a pretty funky risk reversal. And also, obviously, bullish risk reversal, you're selling a put, buying a call. So you have to be comfortable on that short put strike, buying the underlying. But if you are cool with that, obviously capital-wise, it's a much more efficient way to go. So you are rewarded for having a little bit less delta there. You get a little bit more capital efficiency to make up for it. Dan, what are your thoughts on just going out and using the old bullish risk reversal instead of buying stocks, sir?
Yeah, I mean, it can be great. You can get some great leverage. Presuming you're using different strikes, selling or you're selling a lower put strike, buying a higher call strike. Like Mark said, you got that difference. The delta's not going to be 100. And regardless of what strikes you use, you also want to be aware of early exercise things and dividends and stuff that comes into play. But yeah, I mean, it can be great. Yeah, I love it.
And hopefully you guys love this show. I've seen your feedback, see the numbers. You guys clearly do. We appreciate all of you out there. We squeeze as many of you in as we can. We'll squeeze more of you into future episodes. Don't you worry. But unfortunately, that music means we've come up against it for this episode of the Old Options Bootcamp. But before we go, maybe you have a question about earnings, trading, or using bullish risk reversals or anything else in the world of options, and you can't wait until our next episode. Mr. P, where should they go? What should they do?
Surf on over to the Options Insider. No, to Market Taker Mentoring.
Hey, we'll take that too. We'll take it.
I got this. Something popped up on my screen. I got this thing and it distracted me. Sorry. Oh my God, space case. Surf on over to markettaker.com, 2 T's in a row, and we're glad to chat with you and help you out any way you can.
There you go. Check them out, markettaker.com. Don't forget the second T for theta. markettaker.com is the place to go. And on behalf of Mr. P and myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live. We love you folks, of course, for submitting those questions. Keep those coming. We love to hear from you guys as well. And we'll see you back here next week for another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.